The global financial system is showing cracks again, but this time the warnings are not coming from the news. They are coming from the balance sheets of governments, the emergency meetings at central banks, and the sudden shifts in institutional behavior. Something is tightening beneath the surface. Liquidity, the lifeblood of global markets, is quietly draining. Yet the public is being told everything is stable. The reality is different. Over the past year, debt levels surged to new highs. Interest payments crossed dangerous thresholds, and banks increased their reliance on short-term borrowing to survive. These are not healthy signals. They are early signs of a liquidity squeeze forming in slow motion. Every major financial crash in history started the same way. Rising debt, shrinking liquidity, and officials telling the public not to worry. The system is running out of room. Nations are borrowing more just to pay the interest on previous borrowing. Banks are depending on overnight funding to stay afloat. Even the strongest economies are facing the consequences of years of money printing, rate hikes, and structural fragility. The liquidity problem is not a future threat. It is here now. But the most important question is this: why are global institutions accelerating their shift to digital settlement at the exact same moment liquidity is drying up? The answer is simple. They know what is coming. They know the old rails cannot survive another financial shock. And they know the world needs faster, cheaper, programmable liquidity channels that can operate 24 hours a day. This is why tokenized treasuries are exploding. This is why banks are testing blockchain-based liquidity pools. This is why stablecoins are processing more cross-border value than many national banking systems. The world is preparing for a new liquidity era, whether the public recognizes it or not. When liquidity dries up in traditional markets, the system becomes brittle. Payments slow. Credit tightens. Markets seize. But on blockchain rails, liquidity is not limited by banking hours or jurisdictional barriers. Digital assets move instantly. Tokenized collateral can be deployed on demand. Stablecoins create global dollar mobility without banks, and private settlement networks bridge assets that do not normally connect. This is the part of the story most people miss. The liquidity crisis and the rise of digital assets are not separate events. They are the same event. The pressure of the old system is forcing the world toward a new one. Networks built for settlement and liquidity movement are becoming essential. XRP, XLM, XDC, and other ISO-aligned systems are not hype projects. They are infrastructure designed to solve the exact bottlenecks that are breaking the global financial machine. This is why institutions are quietly integrating them long before the public understands their purpose. Behind closed doors, central banks are running liquidity stress tests using digital tokens. Payment giants are experimenting with cross-border corridors powered by blockchain. Governments are drafting emergency digital asset regulations faster than ever before. None of this is coincidence. It is preparation. The truth is simple. The liquidity crisis is not an accident. It is the final stage of a financial system that has been stretched past its limit. And the leaders of global finance know that digital rails are the only way to keep the world from freezing during the next shock. The shift is not optional. It is required for survival. The decade ahead will be defined by the networks that can supply instant liquidity, instant settlement, and instant market access. The world is moving toward a single digital liquidity layer. Some assets will become irrelevant. Others will become critical. They are not admitting the crisis publicly, but their actions reveal everything. This is LTL Productions. Stay informed. Stay early. Stay ahead.